We are in the thick of the real estate spring market, and it is mind-boggling as to how many people are paying cash for real estate. 500,000, 700,000, $1 million or more cash. Wow. Now, if you've got an extra 700,000, 800,000 or $1 million lying around and you can pay cash for a home and you don't want a mortgage, makes complete sense. But for a lot of people, they're divesting investments, they're borrowing from family just to have a cash offer to win that deal. Well, let's assume that you're a home buyer and you do have the wherewithal to pay cash and it does win you the contract. That's fantastic. What do you do next? Well, this week's total cost analysis is going to be a quick look at a delayed purchase loan, where this is when someone pays cash for a home and then within 6 months of the purchase, they do a cash out refinance. It's called a delayed purchase, to pull money back out, to replenish investments, pay back family members, whatever the case. Looking at the total cost analysis, what we're comparing is an $800,000 purchase. First column is cash only. So buyer pays $800,000 for the house, no interest rate, no mortgage, payment, taxes and insurance, estimated $800 a month, total cash to close under $810,000. Fantastic. Now, what if they bought the home with cash and then turned around and did a delayed purchase, pulling out 75% of their funds? That would give them a $600,000 mortgage, cash out refinance, 7.25% rate, payment $4,800, and they'd pull out about $587,000 after settlement costs. Or second one would be a delayed purchase, 60%. So $800,000 purchase, they already own the home, pull out $480,000 loan, 6.99% rate, payment $3,900, cash out $468,000. And let's not forget that, yes, we will at some point in the near future, hopefully sooner than later, have a refinance potential. So this is taking the same 60% scenario at a refi, assuming rates drop down and under 6%. So a 5.75% rate, payment drops $400 some, $3,500 payment. These are the scenarios to look at. So what do? Person pays cash, don't have a mortgage, that's fantastic, but also don't have investments. Well, this is where the total cost analysis really shines. And I'm going to switch views quickly. Let's take a look at those loans 5 years in the future, or those scenarios. The person that bought the house cash, assuming a 5% appreciation rate, equity, about $1 million net worth. Fantastic, not bad. We all know that prices have been moving much faster in this area, DC metro area, so 5% is probably very conservative. Well, the person that took out the 75% loan, they're still going to have some equity built with appreciation, about $454,000. But what if they took that $587,000 and invested it and got 9.9% average rate of return the last 30 years? That's $1.415 million net worth. The person that did the 60% loan, again, they're going to get a bit more appreciation, $569,000. Total net worth, $1.335 million. So does it make sense to pay cash and sit on the real estate? You're probably not going to go wrong, and you're not going to have a mortgage payment. That's fantastic. But looking at net worth, again, after costs, after payments, having a mortgage and investing your cash, keeping or putting it back into investments, keeping yourself liquid, at the end of the day, higher net worth. If you'd like a total cost analysis for a delayed purchase scenario or a refinance scenario or just a regular purchase scenario, just give me a call. I'd be happy to put one together.